Okay, good day, everybody. This is the Option Professor of OptionProfessor.com, and we are going to be talking about investing and long-term trading type of situations. And I'm going to be giving you my input on it. Now, a quick background on the Option Professor, graduate of Boston College, been in the investment industry for 3 to 4 decades, trained at the Options Institute in Chicago Board of Options Exchange. So at the end of the day, I've got a very large amount of experience and knowledge, and that's what I'm going to share with you right now. With regards to what we're going to talk about, it's going to be my opinions, our views, and we're going to be sharing that with you. But what we're not going to be giving you is investment advice. Again, that's for your brokerage firm to figure out what you're suitable for, what you're not suitable for. Obviously, I've not met all of you, so I couldn't tell you what you should or should not be doing because I don't know your circumstances, right? So anyway, what I'll be giving is opinion and observations. And so please, that is the limit of what I can do for you here today. Now, let's get into it and let's talk about the markets right now. The S&P 500, as you can see, is lost its gains today as we speak. But I'm looking at the 20-year graphs on these things because we're talking about long-term investing. And so I'm going to be showing you different stocks that, here's my view, my opinion. When the market tanks like it is now, it's either going to, in my opinion, it's either going to stop at that 3,600 number and we'll probably have a soft landing, or we're going to probably go down to this 2,800 to 3,200 area and have a hard landing. Okay, those are the two scenarios that I basically believe in right now. And, it's probably 50-50 which one's going to happen. You see how far you are from the green and the red line, which is the shorter term SMAs. Sometimes the market will go up and try to fill in those gaps a little bit. So it is possible that you are going to rally off of this thing and try to fill in those gaps. Other times, as you saw in 2020 with the COVID crisis, and you saw a little bit here in the 2018, and of course, here's what you saw in 08, and here's what you saw in, you can barely see what happened in 2000. It tends to go down quite a bit. And so again, some of the other markets have broken through the blue line, which is the 36 SMA, and has already come down to these areas here, some markets. So it's not unheard of that this will break ultimately, and it will come down here. But right now, there's no evidence of that. So basically, we'll be looking and operating as if this 3,600 might be the low. Okay, so when you have a market drop like this, my opinion is you would look towards the Cadillacs, the top, the creme de la creme of the industries, right? Of the sectors. And so basically that's what I'm going to be doing for you today. I'm going to be looking at things that have really been sold off quite a bit, but they may have still good businesses looking forward. And then rather than buying a position where you obviously have to put up a lot more money and you're at risk for a lot more money, taking a limited risk option position, going out, a year or two, and basically have a limited risk and establish a position for a limited amount of money, leave it alone, and see what happens in the next 12 or 24 months after, obviously, some of these things may digest themselves. This is the thing that I think may be of interest to people right now. So we're going to be talking about long-term trading and taking advantage of prices when they're down, which they obviously are. And obviously the call options are going to be lower than they would be at the highs, right? So they are way down. And implied volatility as of this broadcast is in the 24-25 range, which is elevated a bit, but it's certainly not at 35 or 40. So the option premiums, are not as elevated as they had been. And certainly not as low as they could be if the market went sideways. But sideways in this kind of environment doesn't look like a high probability. So at any rate, the VIX is in the 24-25 range as we speak. Okay, so so you get the idea here. The market has gone in the tank. And what are we going to look at? We're going to look at some of the top stocks in different sectors and see if there's an opportunity to establish limited risk positions way out in time so that you obviously take advantage of the low prices. But when you go to bed at night, you know exactly how much to the penny you're at risk for. And that can't be said if you own the underlying stock. So, I mean, certainly not to the same degree as a limited risk option. Okay, so let's take a look at, you see the S&P's down. Okay, so let's go look at the first sector and let's look at the financials. Two of the Cadillacs in the area are JP Morgan. And you can see the blue line on JP Morgan has broken. Okay, and that's not good, because somebody obviously is very concerned that maybe there's going to be a recession. Maybe there's going to be some defaults on some properties. Maybe there could be some defaults on some loans. And maybe these companies are going to lose some money. Okay. Now, again, it also did that in 2020 and it got right back up again. So again, we don't know exactly how this thing's going to shake out. We do know that it's come down here to where these former highs were. So there could be some support in this neighborhood. The RSI, which I had on this graph, but I'll have to put it back up apparently. Give me one moment to do that for you. The RSI on it is also under 50. So it doesn't look very good here, but let's just say you thought it used to be at 170 and you thought over the next couple of years, it could definitely have a throwback rally towards that high again. Okay, let's look at another one here, Bank of America. I'm going to show you the stocks, then we're going to talk about the options, but I want you to understand why we're looking at it. And I'll give you I'm using the high price as the target. Okay, the Bank of America had a high price of 50. It's one of the big holdings of Warren Buffett. And basically, you can now mess around with it in the 30s. Again, it's under the blue line, just like it was here, just like it was down here. So it's probably either going to be a bargain down here, or maybe it's going into one of these kind of deals, which we hope not, because that's certainly a very bad situation. And that's during the crisis of the great financial crisis. There's no evidence of the great financial crisis, although anything could happen in the markets, right? But, you know, if it's just going to be this kind of a penetration, then back up, this could be a good time to look at Bank of America. So that high was at 50. So there's your financials. I'm going to turn now over to these metals. You know, one thing about metals is, you know, they can't print them, and you have to mine them. And then they are used for things such as infrastructure, or they're used for other industrial purposes, or maybe in this case of gold, it's just a reserve against paper currency. Okay, let's take a look at three of them that you could take a look at. One is going to be Freeport-McMoRan, which is your copper. And copper is very much needed in the construction and infrastructure. And this thing, this is one of our favorites because we did get in there at around 8 or 10 and blew it out at 50. So 45, 50. So look, it's right down on its long-term line. So if you're going to take a look at the copper, it doesn't look like this is a terrible place. The high used to be around 52, and then it also was above 60 at one point. Can you see that back there? Okay, so again, that's what makes it kind of interesting on the copper. Okay, looking towards Newman Mining. In my view, the Cadillac of gold stocks. And this is another one we loved at 55 and blew out when it went towards 80. Okay, can you see why we were fooling around with it here at 50? Because it started to hold the line. Here it broke the line. Okay, but it is much lower than where it was. And gold obviously has been on the defensive. So if you thought this was a decent value down here, you know, it has been as high as 85. And if you're, this pays a dividend. Okay, so here you're owning a gold oriented investment that actually gives you income. That's not terrible. Okay, next one is going to be Cleveland Cliffs. These are industrial metals, and industrial metals, you know, basically are different than just the gold. But basically, Cleveland Cliffs, I mean, you know, this thing recently just hit as high as, let's see here, just hit as high as about $35. Now it's at 15. Excuse me. And basically in history, you know, it's been as high as anywhere between 80 and 120. So, I mean, if this thing got going, you know, it really could have something going for it. So there's your industrial metals. Let's turn towards oil. You know, a big one in Buffett's portfolio was Oxy. And Oxy is at 60. Recently was at 75. And in history, it used to be 105, 110. Okay. And now you got the drillers and the guys who are going to develop supply exploration and that type of thing. So let's look at the two Cadillacs there, which is Halliburton. And that's at 28 bucks. Recently was at 45, and it's been as high as 75 bucks over time. So you're seeing that. Maybe you make notes of these because we're going to go look at options on them afterwards. But I want you to see on the graph what they look like. And they're on sale, correct? Okay. So next one is going to be Slumbershay. Now I'm only going to be doing a limited universe. You can do it on any stock you'd like. So here you go. This one used to be as high recently as around 50 bucks, but it also was as high as 80 to 115. Okay, and then let's take a look here at the next sector here, which is healthcare. And I'm looking at biotechs. You know, these are the guys that come up with the next pharma stuff, right? And this thing used to be 180, and it bottomed at 60, and it's now at about 81. Recent highs, let's call it 100 to 120. And this is S&P Biotech. Okay. Another one that looks kind of interesting to us is medical devices. You know, this is your hips and your knees and all that stuff and all kinds of medical devices. And this thing used to be as high as around 66. And it's currently at 50 bucks. Not quite as exciting as biotech. Okay, now I'm going to look at the tech sector. And Nvidia is going on the screen because according to what I've heard, Paul Pelosi bought 20,000 shares of Nvidia. And he's the husband of Nancy Pelosi. So I don't know what that means, but I guess people were saying that he has had some success in the past. So not only that, I mean, Nvidia is obviously a very good company as far as their products. Their valuations are all over the place, and that's why the stock's all over the place. So anyway, this thing used to be 350, and you're looking at now at 163. So this is Nvidia. And take a look at that. And it came down to the support on the blue, right? So, you know, if you're going to take a shot at it, this looks like a neighborhood, right? All right, next one is Facebook, which is now called Meta. Now, the only reason I'm putting Meta in here is because they still have the eyeballs. And because they still have the eyeballs, the fact that it used to be at 380, more recently at least 240, the price of 169 seems a little bit reasonable, and it is in the lower area where it has ever been. And they do have the eyeballs, meaning people are still going to this platform. Okay, and the next one is Netflix. Now, again, Netflix is another one who is used to be very high priced at $700, most recently $450, and we're looking at it at $194. So you get the idea, and look how low it is. And of course, these guys have plenty of subscribers and plenty of people still using it, right? So that's why we're looking at Netflix. All right, and then of course, let's look at the Cadillacs here, which is Amazon, with their Amazon Web Services, king of retail, right? And Amazon used to be as high as 190, and now you're looking at it at 114. Now, and these are now split, so they're cheaper to work with. And how about Google, also known as Alphabet? And that one is used to be 150. Of course, that's, you know, times 20 is 3,000. And then basically it's at 109, and you can see it's holding the line here pretty good. So that had a high 150. Now look at Microsoft. And there's the Three Amigos. And there you go. Microsoft used to be as high as 350. And you're messing around with it at 250. And then you might as well throw the last one up there, which would be Apple. And Apple used to be as high as, I think, 182. So we'll take a look at a few of the tech stocks like that, okay? And then after that, we were going to look at home builders because they have been under a lot of pressure. Yeah, it used to be at 85, let's call it, on XTB. Let's say if we look at one of the D.H. Horton, they make inexpensive homes. Let's see how the inexpensive homes look. 72, it used to be at 110. Yeah, let's take a look at D.H. Horton. And that used to be at 110. You're looking at it at the 100. I mean, you're looking at a 73. And how about one more, Lennar? Yeah, it's even better. Well, it's about the same. Yeah. 110. Yeah, same thing. So we'll just stick with the one. Next one up is going to be in the agricultural area, Archer Daniels Midland. Now, this is food, right? So I'm trying to get into the stuff that, there seems to be some problems with, if there is. Now, this one used to be at 100 and you're looking at it at 70. So again, obviously it still could come down further here, but the trend is still pretty much up. So if you are thinking that, again, food is going to be a problem in the future, Archer Daniels Midland seems to benefit from that. Okay, and then let's just do one last one here in that area. Let's see what this looks like first. Okay, and that's Mosaic, and they are into fertilizer. And so they used to be at 80, and you're looking at it at 45, Mosaic. And that was 100, this is used to be 80. All right, and let's see, one other one I was going to look at was Boeing. Boeing is a company that has had a lot of bad news, And this stock is going to show you that it has gone down quite a bit, but it's also showing you that it's turning up. So here's where you are on Boeing. It used to be $440 a share. And more recently, it was at $280 a share. And you're looking at it at 148. Okay. So there are some companies there that we're going to take a look at. And you can do any company you'd like. I just tried to go around the horn and look for things that have been dropped off considerably that hopefully still would be doing well down the road. And you can do this on any stock you'd like. I'm just giving you a little bit of a smorgasbord of different industries to take a look at. Okay. So, and don't forget on Boeing, it's a 2-horse race. You've got Airbus and you got these guys, and they both are off the highs. Okay, now we're going to start looking at options so you get an idea of what we're talking about here. Because again, we're talking about long-term investment type strategies. And this is going to be speculative because you're dealing in an option. Okay, so the first one up is going to be JP Morgan. Okay, so you go JPM and you hit that. And then you go to option chain here. And this will give you a little idea of what's going on there. We go out to as far as you can. Why not? Go to June 2024. We're at July of 2022. So you got almost 2 years to see something happen here. Okay, you're at 112 on the price, right? Okay, you got a target up here of 170. Okay, so you always try to go a little bit in the money, a little bit out of the money when you're trying to do options, right? So you go a little bit out of the money here, and let's say you pick up the 115s for, let's say you round it off, $16. So you're going to put up $1,600 for the right, but not the obligation to purchase 100 shares of JP Morgan at 115 between now and the third. Oh, when do they expire? June 21 of 24. You see my cursor right there? That's the expiration date. Okay, so what's going to happen between now and then? It could go up, it could go down, it could do anything. Let's talk about if you hold it all the way till June of 21 and all the time premiums out of the options. If we are under 115, you will lose $1,600. This is not counting fees, commissions, or any other charges. So this is an illustrative purpose, but that's basically premium only. All of these examples are going to be the same, premium only. And basically, so if you buy the option for $1,600 and it's under 115 and 2 years have gone by about, you're going to lose what? $1,600. Let's say it goes from where we are here to halfway between where we were and where we are. So that would be say 110 to 170, and that's $60. So it goes up $30, and now you're going to be at about 150. Okay, at 150, you are at minus the 115 you have the right to buy. You're going to be $35 in the money, $35 of intrinsic value. That's $3,500. Minus your $1,600, you look like you got a double on it, a little bit more than the double. Okay. Now let's take a look at that 150 and say we were to, now, of course, if it goes up to 170 where it came from, 170 minus 115, you got $5,500 because it's $55 in the money. So at $5,500, you got quite a substantial gain off that $1,600. Now you could do what they call a spread, a bull call spread. And if you buy the 115 calls for $16 as an example, and you sell the 150 calls for, let's say, $5 as an example, right? Because you see the bid is 490, so I'm rounding it to 5. This is for illustration purposes. You'd have a differential of $11, which is $1,100. Now, if we went to 150 or better, that spread has the potential of going to maximum 150 minus 115, it goes to $35. Okay, times 100 shares, $3,500. Your cost was down to $1,100. So now your $1,100 has gone to $3,500. If we can get to 150 or better and close there by June 20, on June 21st, 2024, all the times out of the options are now expiring. You're above 150. And then the spread could go to a maximum of 35, maybe 34. So that's quite a bit of a potential gain. So that gives you an example on JP Morgan. If you want to take a long-term position, limited risk, have a lot of potential, and you know exactly every time you go to bed at night to the penny what you're at risk for. Okay. All right. Next one up is going to be Bank of America. Okay, Bank of America is trading $32. What did we say? It used to be as high as 50. Okay, we're going to go over to option chain here. We're going to go out here. We're going to go out to the cheap seats here, the June 2024s. So now you got, till June 21, and you go a little bit out of the money. You're going to buy the $35 calls. You're going to pay $460. $460 is not a bad premium, really. So let's say $460 is what you pay, because you can see that's the asking price right now. And let's say it goes back to 50. 50 minus, where are you buying it at? 35. It would be $15 in the money. That's $1,500, and you put up 460. Not bad. If it's under 35 and all the time is run out, you lose the 460. Now, what about if you spread it? No, you take, let's say you go with the 35 calls and you try to sell the 45 calls and you get 160. See, 160 is the bid. So 460 minus 160 means you're going to be putting up $300. And you got the right to buy, but not the obligation. 100 shares at $35 between now and June 21st of 2024. Simultaneously, you're selling the $45 call for 160, which means you're obligated to deliver stocks, 100 shares at 45. So the differential there is $300. That's what you're on line for. If it goes to 45, right? The spread between 35 and 45, it's, again, all the time premiums out of the options, it's above 45 on June 21st, 2024. That spread could go to a maximum of 10. And you paid 3. So you've got 3 times on your money or better, because Bank of America went back to 45. Okay. And you got till June 21st of 2024 to see it happen. Now, word of caution when you're selling any option, you can always get assigned one side of it. So again, you have to be careful as you get into the money on the or near the money on the $45 call. If there's any dividends that are going to be people going to try to capture or any other things. So if the spread can only go to 10 and you start approaching that 45 and you can get probably 8 or better, you know, it might be time to take your money and run. Because again, if something can't go higher than 10 and you can get 8 or 9, you're not leaving very much for the postman, and you are locking in a win when you obviously actualize the sellout. So that's another word of caution for you there. Again, I've been doing options for decades. I hope you guys are getting that now, and that's why these things flow off my tongue very quickly. Options are not right for everybody, so you got to talk to your brokerage firm and see if they're right for you. Suitability is a very big thing with options, and not everyone is suitable for them. Let's get that right up front. Okay, let's go back to the board, and let's see what Freeport-McMoRan might be able to do for us. Okay, Freeport-McMoRan. 27 bucks. It used to be 52 to 60. This is copper. What do we got going on in copper going out in time? How far out can we go? How about January of 2024? That's pretty far out. All of this year, all of next year, and into January of 2024. January 19th it expires. Okay, a little bit out of the money, right? Well, let's see here. If you go $2 out of the money, you get it for about $6. I'm going to round it down. You're at 620. Let's just round it up because it's only for illustrative purposes only. Okay, so you're buying a 28 call and you're paying a $30 call and you're paying $6. If it goes back to 52 minus 30 is 22 bucks. Again, each option is 100 shares, the right but not the obligation to buy at 30 for 600 bucks. Now, at 50, this thing is worth 22 bucks in the money. 50 minus 30, I'm sorry, 20 bucks in the money, right? 20 bucks for 50 minus 30 is 20 bucks. That's 2,000. So you put up 600 and it went to 2,000. Not too shabby. If it goes back to the high of 52, by when? By January 19, 2024. Now, again, it can, because it's not in the spread, it could happen at any time in the interim. Okay. You don't have to worry about all the time premium coming out or anything else because you're just long the option. All right. Now, if you wanted to spread it by selling a, let's say a 45 call, that's going for 234. Let's round it up to make our math easy, 250. Now we'll go to 2. So you're paying 6 on one and you're going to get 2 on the other because you're writing or selling the 45. So you're going to pay the difference, which is 6 minus 4 is 2. So you got 200 bucks going here. You got the right to buy at 30. You got to give it up at 45. And you paid how much? 400 bucks for it. Okay. Okay. If by January 19th, 2024, all the time premiums out of the options and we're trading above 45, that spread could go to a maximum of 15. 45 minus 30 is 15. 15 times 100 shares is 1,500 bucks, and you put up how much? 400. Not too shabby. Okay. If we are under 30 on either of those strategies, you lose all the amount that you put up. And that would be, again, you have until January 24th when they expire. But again, obviously options will go down in the interim. You know, they move around, as you would imagine. But they are limited in risk, and you do have the right, but not the obligation if you're long. And then again, on the short position, you are obligated to deliver stock at the higher strike. Obviously, I used to say to this, everybody, when you buy the $30 calls and then you sell the $45 calls, you are hoping you're selling those calls to Albert Einstein, meaning a genius. Why? Because if he's going to be right on the 45 calls, you're going to be very right on your 30s, right? So when you sell the out of the money call, your hope is that you're selling it to a guy who really is a sharp genius, because if he's going to be right, then you got to be right because you've got the $30 call. Okay, so that's their Freeport-McMoRan. Let's keep going here so we don't run out of time. Newman Mining. This is something we liked at 50 and it ran up to 80 and now it's back at 50. This one pays a dividend. I think Freeport does as well. I'm not sure, but you don't get the dividend on options anyway. But at any rate, if you're buying the stock, you do. Okay, so on the Newman Mining, you can see it on the graph there. It has totally gone back in. This is a gold stock and gold's on the defensive. So if you're a believer, gold's not getting underneath 1700, this might be a neighborhood to do something with it. If you think gold's going to 1400, you wouldn't want to do this. All right, so let's go down to January 24 and let's see if there's something there for the gold bugs. This stock hit a high of 85. Okay, now this goes off the board January 19th of 2024. Okay, you go a little bit out of the money. Let's go to the $60 calls, pay 7.5. So you're buying a $60 call in this example, and you're paying $750 as an example. Okay, right to buy at 60, not an obligation. And where you want it to go, you want it to go back to 85. If it goes back to 85, 60 minus 85 is $25. 25 times 100 is 100 shares. That's $2,500. You paid 750. You got better than a triple on your money if it can go back to the high by January 19th of 2024. If it goes beyond there, because gold has one of those kind of crazy rallies that it can have when when the wheels fall off the system, or if you think that could happen, if that's your speculation, then basically that would be something to look at. How about if you did a spread? And you buy the $60 calls for 7.5 and you sell the 85 calls for 2.3. That gives you a differential of 5.20. Now, if we go back to 85 and all the times out of the options, and they're trading at intrinsic value only, and it's above this higher strike of 85, and it's January 19th, and we're expiring, the spread could go to 85 minus 50, 60, I'm sorry. So in that case, you can go to 2,500 still. But here your cost coming out was only $520. So there you got almost a 5 times deal on your money if it can go back to 85 by January 19th, 2024. Again, it has to be above the top strike and all the time premium and volatility premium. It has to be trading only at intrinsic value. And again, caution that you could get exercised on a short position in options if there was a dividend to be captured or if any other type of thing can occur. So you got to be careful of that as well. Okay, because you wouldn't want to get exercised on one side and own the other, because they could actualize a very big loss on the short position. And then if it comes down, what was protecting you on the long position could then be a loss, much greater than the spread differential. That's why you got to be careful when you do any type of shorting of options, exercise. And if you're not clear of what I'm talking about, there's a book called The Characteristics and Risks of Standardized Options you should pick up. And you should definitely be talking on any of this stuff to your brokerage firm, again, for suitability and complete disclosures. Okay. All right. So let's turn to Cleveland Cliffs. Again, these are metals that come out of the ground and, they have to be produced. They're not paper that you print unlimited amounts of. So Cleveland Cliffs is industrial metals, and it was doing quite well, and then it's not doing quite well. So, but you saw on the chart that it has been as high as 35 recently, but in the last 20 years, it's been as high as 80 or 120. So, this thing does have some type of potential if things really got going. Here we are looking at January again, 2024. These are called long-term options. And here you can go a little bit out of the money to the $18 calls and pay $4. So here you buy an 18 call in this example. These are all theoretical examples at $4, which is $400. And you have the right to buy at 18. Okay. Now, say it goes back to 35. It just was at 35. And let's say the circumstances of the world are totally different in 2024. And all of a sudden, people are jumping into this stuff again because there's a need for it, whatever. So if you go to 35 and you have the right to buy at 18, you would be in the money by 17 times 100, because every option's 100 shares. That's $1,700. and you're into it for $400. So you've got more than 4 times on that one if that were to occur. If it's under 18 and all the time runs out, the option will expire at 0. You'd lose all the money. In the interim, it could easily go, and all of these options can go from 400 down to 0 way before January 19, 2024, because if the price of the stock goes down and stays down, then obviously time premium starts coming out of the option. And so you can see it shrink to 0 way before that date, but you would not have an expired option until it expires on that date. Okay, so there you go on that. And then if you spread it, say you sold the 35 calls for $1. If you pay on the 18 call 4 and you sell the 35 calls for $1, the difference of 4 minus 1 is 3. So that's $300. Now, if we go to 35 and all the time premiums out of the options, so you get the full spread of $17. That's $1,700, and your total risk was $300 going into it. Okay, so that would be a pretty good one too. All right, so there you go on Cleveland Cliffs. Let's turn towards the energy. Okay. Occidental Petroleum I picked because that is also a big holding of Warren Buffett, and let's assume he's done some homework on it. And of course, he's a longer term holder, probably a lot longer than 2 years on it. But basically, you know, this is something that he has definitely made a commitment to. And basically, it had been as high recently as 75, and it has been as high as 105, 110 over time. So we're going to option chain here. Now we're going to see what's cooking. You go out to January 2024. And you look at a little bit out of the money. So you look at the 62 calls here for $14, 62.50, I'm sorry. And you pay $14. Okay, with that kind of a premium, you know, you might consider spreading it because it would really have to go up towards the 105, 110 area to really make any money on that. Because again, if you hold till expiration, 62 plus 14 is 76.5, and that's even higher than the recent highs. So that one, you know, would almost, encourage you to spread it. But if it goes up to 105 or 110, you know, then it can go to a 40. They can go to a $40 or $50 option, and then it would make more sense. So here you're really hoping for a big home run deal. And again, that might be a tough one. So let's say you just did a spread on this guy and you sold the 75 call. So the 75 calls are bid at 10. So this is a little bit more reasonable because you're buying for 14 at the 62 price. You're selling the 75. Well, let's go and make it 77.50 for 940. So you're 14 on the in and 940 on the credit from the 77.50s. So the differential there comes down to $4.60 because you're buying one, selling the other. If it can go to 77.50 by January of 2021, there's your expiration, 2024. That spread could go to a maximum of 77.5 minus 62.5 or $15. So $1,500 would be the maximum the spread could be if it's above 77.50, all the time premiums out of the options at expiration, or if it goes deeper in the money prior to and all the time premium comes out. You paid $460, maximum $1,500. Again, all of these positions, if it goes under the lower strike price and the time runs out, they will go to 0. You will lose all the premium you put in there. So you have to realize that's the risk on it. Okay. And again, it can go to 0 before expiration as well. So you have to be aware of that as well. Okay. Turning towards Halliburton. Halliburton used to be as high as 45 recently, 75 prior to, and going all the way out to January 2024. Stock is down to 28 bucks. You go with the 30 calls for 7. Again, the recent highs are 45. So if it goes to 45, the 700 you're putting in could go to as much as 15 if it goes to 45 or better. Now, if you spread it and you buy it for $7 on the $30 and the 45s are sold for 2.41, you can get a differential of 400 and I'll round it up $60 for the spread. And if it goes to 45 or better, that spread can still go to 15 or 15 max, again, under the circumstances I mentioned, and you'd be able to get about a 3 times on the price you paid. Again, if it's underneath the lower strike price, these options can and will go to 0, and they can and will go to 0 possibly prior to expiration if it really falls down and then time runs out. So you have to be careful of that. You have to be aware of that. Okay, I don't want to run out of time, so I want to get into some of these tech stocks. I know you guys like tech, so let's go fast on that. And I'm not going to go over spreads here. You know, basically, if you don't know, you got to read the book and you got to talk to your brokerage firm and get full details. So I'm just going to go on absolute outright buys so I can get to everything. Okay, Nvidia. Stock is used to be or 350 bucks, you're looking at it at 160. Let's go look at what these options look like and see if there's something. Now, again, valuations were quite high on this, so it may be very impossible to get back up to those valuations. You know, let's get that out there. But if you're a believer that it could happen, you know, then basically this is something that I didn't want that one. Yeah, this is these are, you know, for people who are believers that the price of these things are going to go back up, maybe not all the way to their highs, but you know, back up a lot higher. Okay, so on Nvidia, the June 2024s, they expire again in June 21 of 2024, almost 2 years out. The stock is at 62, 162. If you buy 170s, you pay about 45 bucks. If the stock went back to 300 minus what, 170 would be 130. So they go for 13 grand, and you are putting up 40. If you bought them at 45, you'd put up 4,500. So that's 4,500 because it's 45 times 100 shares. That's 4,500. And if it went back to 300, you could get as much as the differential. Okay, let's take a look at any of these other ones here. Microsoft. Okay. Okay, Microsoft, you can go all the way out till June of 2024. And a little bit out of the money at the 260s. These are 2024s, right? No, these are 2022. There you go. I thought they were a little cheap. Okay, yeah, here, yeah, more like it. Here you got to put up about 5 grand, 4,800 to buy the 260s. And if it goes back to 350, they would go for 9 grand. Okay. And if you spread them, you can do your own math and do the homework, do the math, figure out the risk and the use and the reward, go from there. Let's take a look at some of the ones that have really fallen out of bed here. Netflix. Okay, we know Netflix used to be 700 bucks and recently 450. So let's take a look at what the options look like on those. All right, we go down to June of 2024 on Netflix. Let's see if there's something there. Okay, you go a little bit out of the money, you pay $61 for the 200 calls. If it went back to 450, those would be in the money by $250. So that's 25 grand. And you would have put up about 6,100. So you're risking 6,100. If your target got hit, which is up at the 450 mark, that would be the potential gain. Again, the risk on the when you buy them outright is limited to the premium, and you will lose the entire premium when they expire underneath 200, or you could lose the premium long before that if the market stays down and the time starts running out. These things will shrink. So that's why when you're buying options, you have to be willing to risk the entire amount you've got, but it is limited risk. And this stock has dropped. This stock has dropped from 700 to 200. That's $500. If you lost $50 on it, you'd be a lot happier than if you lost 500. So one of the beauties of the options is the limited risk. The negative is you're fighting time and price. And obviously time and price are very much working against you when you buy the options. All right, let's look at Meta. As you notice, some of these options are quite high, so the potential gains are not quite as great because obviously the premiums are larger. Okay, so Meta's at 168. It used to be 380 and 240. So let's see what they can do for us out here in the La La Land 2024. Okay, so you go a little bit out of the money here. You pay about $45 to buy it at 175, right? And if it went back to the lower area where it has been, which is 240, minus your 175, you'd be in the money by $65. And that is going to be 4,500 going to 6,500. Not a tremendous gain there. Again, if you spread them, obviously that's very helpful with this type. If you're going to do a longer term position on something like this, it almost encourages you to spread them so you can take in big premium. Like I'll give you, for instance, here, if you buy the 175 for $45 and then you sell the two, where'd it come from? 240. If you'd sold the 240s for 20, let's call it $23, you'd only be putting up $2,200. And then if it goes up to 240 or better, you can take $6,500 out of something you put in 2,200. Now you've got a triple. So spreading it makes a lot more sense when the premiums are this high. Okay, one last one I'm going to sneak in here. Just a quick one. Boeing. There's only two horses in this race, Airbus and Boeing, it seems like. So let's see what Boeing looks like. They just got a big order here recently on these Maxes from Delta. And some people think they have some potential up here. I'm going to try to squeeze this in fast. So it's at, come on, Boeing. There you go. It's at 148. And this thing, you know, I mean, Boeing over time has been very, very much higher. You know, I mean, at one point it was $400. Recently in the last year, it was $250. So, I mean, this thing is definitely, you know, been a lot higher over the last few years, 450, and in the last 1 year, 250, and you're messing around here at 148. So let's go and see if we can get some options up here quickly. Okay, there we go. Okay, so say you're bullish on Boeing, you go out to January 2024. Let's see if there's anything there. Okay, 2024, it's at 148. You go a little further out of the money and you go for, let's go 150 and pay $37. If it went back to 250 and you're in the 150s, it's got to be worth 100, right? 100 is a $10,000 option. You would have put up 3,700. See, that's the premium, 3,700. And so that would be your risk reward on that, $3,700. And then if we went back to 250, you could get 10 grand out of it. You could also spread it. When the premiums are this high, spreading makes some sense. All right, guys. Basically, we're coming to the top of the hour, so I'm just going to really quickly tell you again, this is Option Professor of OptionProfessor.com. Obviously, we're very experienced. We're very knowledgeable on this stuff. We're more than happy to share. We tell you to go to your brokerage firm and find out if you're suitable and if your risk tolerance is in this neighborhood or not, because there is a risk in option trading and it's not right for everybody. So do that. And then, of course, go to our website, OptionProfessor.com. And you can find out about how to hedge against market declines and market advances. We have a PDF report for that. We also have technical indicators we use to figure out what market direction is going on. And then we're available for one-on-one education. And we're more than happy, after 4 decades of it in here, to share with you our knowledge. And I think it'd be very reasonable to you to find out how that works. So you go to OptionProfessor.com, OptionProfessor.com, put in your information, including your phone. We'll check back with you and we'll see if this is right for you. I think you should check it out. I think you're going to like the way it works. So again, go to OptionProfessor.com. Thanks for being with us. I hope you learned something today. Have a good day.